Dick Kovacevich, until 2010, was the chairman and CEO of Wells Fargo, an institution that has survived the U.S. crisis and in fact become stronger as a result of acquisitions made in that period and has become one of the strongest institutions in the world. So we're very pleased to be able to speak with you today. Dick, tell us, what is it about Wells Fargo that made it able to survive the U.S. crisis? And what were the disciplines in place that enabled it not to make the mistakes that many of the other U.S. institutions did?
Well, I think one of our greatest strengths over the past 25 years has been our risk management. We have done a great job of that. We've avoided many crises in the past, and we basically avoided this crisis as well. Even though we were a leading mortgage company, we did not participate in the origination of subprime mortgages, exotic subprime mortgages that turned out to be a very high risk, which we knew they would,
right.
That would result
and
in.
When did this frenzy for originating subprime mortgages, when did it actually start in the U.S.?
Well, I would say that the level of subprime, there's always been some subprime mortgages, and it was well less than 10% of all originated mortgages, and they've been around for a long time. But what happened is, beginning in, let's say 2005 or so, the percentage of originated mortgages of the subprime level went up to 50% of the market, a huge increase. And these were not just ordinary subprime mortgages. The risk were amplified because there was negative amortization of these mortgages, stated income, no doc or low doc documentation of the mortgages. It was kind of almost an invitation for fraud. And we recognized this as these products were being created and decided that it would be totally inappropriate for our customers. And even though we could have originated these loans and sold them to the marketplace, it would not be consistent with our ethics and our values.
Yeah, and during that period, everybody else was growing their market share, and I figured that Wells Fargo would have been losing market share. You would have been slipping. So how did you keep morale during that period when you were counterintuitive, or rather intuitively in the other side of the...
Well, yeah, in fact, we were, prior to the crisis, we were the leading #1 in the market, 15% market share. And in those 3 years of the exotic originations, we lost 4 percentage points, $160 billion of originations each year, and we're no longer the leader. But again, our views, because we've been through these processes before, is that if it's the wrong thing to do, and if it turns out that you were right not to do the wrong things, you will be rewarded in the future. So yes, it was painful for a while, but since we've, again, had this discipline in the past, our people do know that we will gain the advantage in the future if indeed it blows up, and of course it did. And so what happened is we went from 15% market share in the 2005 period, and in 2006, 7, and 8 we went down to 11%. Today, our market share in mortgages is 33%, and we would never have been able to triple or double, depending where you want to start, our mortgage market share if we had not avoided the problems and then taken advantage of the situation once the people who did these mortgages left the market.
So in your more than 30 years of experience in financial services, you've probably seen this several times before.
Exactly.
And so you've sort of internalized the discipline required. How does someone in your position internalize the instinct for this? What is your view of financial services? What is the one thing you should put your finger on so that you don't lose perspective?
Well, doing the right thing is the right thing to do. I mean, it's as simple as that. If you really know when risk is exceeding any kind of a normal level, and you have to have the discipline to say, this is risk that we should not take. We're not getting paid for it. It's wrong for our stockholders and for our company, and it's wrong for the borrower. And what surprises me is how many people failed to see this. Because the risk taken in this subprime mortgage was the most excessive I've ever seen. And what people don't quite understand, there were only about 20 institutions who did most of this damage. And most all of them were not, in fact, there's only one commercial bank that was really part of the 20. All the rest were investment banks, which were securitizing and selling these mortgages. And most all the originators were either non-banks, like a Countrywide, or they were S&Ls.
Right.
What's shocking is that 8,000 commercial banks today are being vilified and are having additional regulation put on them, and only one of the 8,000 were actually a commercial bank, and the rest weren't even commercial banks, and yet we're being punished.
Right. Now, going forward, right through the 2000s, the last 10 years, the investment banks had introduced this, get it off your books, have it as a traded asset. They've also been, taking on the liability side of the business and making investments and so on for commercial banks. And the Volcker rule coming in place is trying to, to sort of put fences around that. The days of great profitability is over in financial services, you think?
Well, I think that the increase in regulatory costs, many of which were not the cause of the crisis and will not avoid the next crisis, has reduced the profitability. I think that over time, and it might take as much as 5 years, people will realize that these additional costs are not making the industry safer. They are increasing the costs, because increasing costs to the banks, they in turn are charging their customers more. And we've already seen that with increases in fees. And I think it's quite likely that some of these excessive regulations that are not necessary for protection of the taxpayer or to reduce the probability of having another crisis will be eliminated. What does reducing debit card fees have to do with this crisis? It's more of anger and punishment with the thought that, again, the banks caused this problem. It really wasn't commercial banks. It was investment banks and S&Ls. And yet we're all being punished as if we were guilty when most of us, the vast majority, didn't even participate in this issue.
And right through your career, because of regulation, you've seen non-bank financial institutions come in, almost as a shadow player and taking some market share. Right through the 2000s, you had Countrywide, calling
Exactly.
the bluff of, the mainline banks like yours. And in the 1990s was the monoliners and so on. Do you think that all of this regulation is going to create, substitutes which are not financial institutions taking on specific business lines and getting around the regulation?
Absolutely, and that's what happened in the past and it's happened in the future. Let's take proprietary trading. There is no indication to me that proprietary trading had anything to do with this crisis. So it's trying to be eliminated, but people are going to do proprietary trading, and it will go outside the banking system and could well cause another crisis, and then it'll be blamed upon banks again. So the S&Ls could only get big as they did and do these originations because their regulator was not as involved as the OCC to see the risks that were being taken. Investment banks got big because commercial banks for a while weren't allowed to be in their business. And quite frankly, if we would have eliminated Glass-Steagall 40 years ago, we wouldn't have had this crisis. And people think that the elimination of Glass-Steagall caused this problem. It's just the opposite of that, is that these banks, investment banks, could not have got as big as they did if they weren't protected by Glass-Steagall. And even Barney Frank has said, and I don't often agree with Barney Frank, but he said that if the insured depositor institutions were the only ones that were in this business, this crisis never would have occurred. And he's absolutely right.
But with interest rates continuing to be low and access to credit, being very open because there's so much liquidity in the marketplace, that risk continues. Would you say that?
Well, yes and no. I want to repeat. of the 8,000 banks out there, only one of these caused this problem. So why should it be any different in the future? Right? I think people are missing the fact that the vast majority of all insured depositor institutions behaved appropriately. And so if they behaved appropriately in the midst of this big bubble where you could have made a lot of money for a while, right? Because
it is a disciplined industry.
I think they did a much better job, and that's not coming out.
You're seen very clearly globally as the father of cross-selling, the father of making the customer the center of a Main Street bank. Just give us a gist of how that thinking evolved in you, and how much work was involved in creating that within Wells Fargo, which as an institution is also seen as a leader in terms of cross-selling. I think 7 products per customer for retail, and the infrastructure that you need to put in place, and the thinking of the people, for example. What was involved in creating this, and do you think that you have a lead in that respect, which makes it difficult for other institutions to follow?
Well, what's interesting about this is we're credited with the cross-selling being a revenue-generating machine, but this was really started going back to risk. If you look, at least in my opinion, what causes banks failures or any other financial institution failures is concentration of risk. Even if you do a good job of underwriting, but if all your business is in, let's say, commercial real estate, and macroeconomic forces cause the commercial real estate market to collapse, you're going to have a big problem, even though you did a pretty good job of underwriting it. So my view of how you manage risk in a financial institution is to diversify the risk. Never be too big in anything, because the macroeconomic forces can cause things to happen that's really not your fault in many ways. And so what that led me to believe is you do not want to be a narrow bank. You know, this makes commercial loans and takes deposits and so on. You want to be a financial services company. So you're in the mortgage business. You're in commercial lending business. You do leasing. You get a lot of fee income. You do credit cards, debit cards. You do all of those things so that if one of those sectors has a problem, you will still do okay because the rest of the sectors are doing well. But the more I got involved with that diversification, we discovered that there's many other benefits. And one of the most important is the fact that that the average customer, both commercial and consumer, buys about 14 financial products. Right. In the past, from a variety of about 5 or 6 companies, because nobody offered the full suite of products. Right. And because we were diversifying, we were starting to provide all a suite of products to these customers. And if you think about it, that the cost of selling an additional product to an existing customer the incremental cost is very, very low compared to the selling that same product to a new customer. You know, you don't have to advertise it. You don't have to go through an account opening process. The customer's probably already in your store, right. So you can just sell them that other product. And it turns out that the cost of selling an existing product selling a product to an existing customer is only about 10% of selling that same product to a new customer. So it's a 90% cost versus a 10% cost. And if you do that, then you can reward the customer for doing more business because you have a nice margin that you can share with the customer. Right. And so, everybody wins. And then furthermore, you find out that the more products you sell a customer, the more loyal they are. They stay with you longer. And when you have customers who are gaining, are able to purchase a bundle of products that in aggregate are cheaper than buying it from 5 separate competitors, makes common sense, and they stay with you longer, you're going to have a very successful company.
Which retailer thinks the way you do? And which retailer do you look at to get your inspiration in terms of this product per customer?
Yeah. Well, let me ask you this. What does Walmart not sell?
When you walk into a Walmart, and what is it that you cannot walk out with?
And what is one of the lowest margin businesses in corporate
Retail.
America?
Retailing.
Well, but what part of retailing is the lowest margin?
Discount retailing?
No, groceries.
Groceries, right.
So why did Walmart enter the lowest margin industry in the world and now dominates grocery business? Do you think the margins of Walmart's grocery business is better than Safeway's? The answer is no. So why did they do it? The reason is people go into a grocery store 5 times more often than they go into a general merchandise store. And so when they added groceries to their general merchandise store, the sales of the general merchandise went up 27%. So that's a form of cross-selling. Think of Home Depot. So before you had to go to a paint, you wanted to do a room, you had to go to a paint store, you had to go to a plumbing store, things didn't fit, and you had to get sheetrock somewhere else, you had to go to a lumber yard. They just took all these various products that were being sold by someone else, put it all together, not only make it convenient, but then someone in that store was an expert to say, here's how these things work better. And that's what our people do. Say, should you have a long-term CD given your risk profile, or should you have a mutual fund?
Right.
Or should you have an annuity? You couldn't get this advice from all the separate providers, because if I was only selling CDs, I wasn't going to tell you that mutual funds are better for you, right?
Right.
So you could only have confidence that you were getting advice if the provider had all these various products and was selecting from all the products that they had what was best for you. So this was in the customer's best interest.
Right.
And
So
this is why all this seemed to me was almost common sense. And I wasn't a banker. I came from retail.
Right.
And from General Mills and from marketing. So I think I had the advantage of
having seen it from that perspective.
of starting with the customer, not starting with, I've been doing checking accounts all my life, so that's what I'm going to do for the rest of my life.
So that's the front end of the business. The back end is the product itself. A Walmart sources its products from the lowest, source and so on. How does a financial institution look at the origination of products? There's the option of manufacturing it internally. It's an option of being a supermarket.
Right.
So what's the Wells Fargo approach?
Well, let me ask you this. Are the products that Walmart sells any different from the products that Target sells or Safeway or whatever?
A mutual fund is a mutual fund is a mutual fund.
I would like to convince our customers that our checking account is a better checking account than Bank of America's, but the truth of the matter, they're commodity products.
Okay.
Just like Walmart is.
Okay.
So the differentiation is not in the product. The differentiation is how you distribute commodity products. So when you look at the skill of Walmart, its skill is basic logistics, right?
Right.
Of taking these commodity products and being able to sell more of them per square feet than others, making sure they get into the stores and so on. It's the same way with us, is how can we take these commodity products and help the customer to decide which one of those are in their best interest and bundle them in a way that is both less expensive, because you're taking some of the cost of the logistics away because you're putting it all under one roof, but you're giving more value to the customer because you're giving them exactly the products they need. But then also, it's one statement. They can do it all online. They don't get 12 statements coming every month that someone's paying postage on. So it's more convenient, less cost, and a better satisfying their needs better. What is business? I mean, if you can do all those three things, you can be very successful, right?
Is there something that Main Street banks like Wells Fargo understands about the customer and being customer-centric, which is very different from, say, what a Merrill Lynch, which is a brokerage, understands about customer and being customer-centric, or a insurance company idea of being customer-centric?
Well, I would say it this way. Everyone admires our cross-selling. Okay? So I've had many CEOs who come and talk about cross-selling, whatever, and they go back and they write a memo to all their staff and say, I want you to cross-sell tomorrow. That's not how it works. The bad news is this is hard to do. It sounds easy. So let's go back to the Walmart example. Does anyone not understand Walmart's strategy?
Okay.
So why doesn't someone duplicate it?
It's too hard.
It's hard. So the best strategy that you can have is a strategy that is a superior business model that is hard to do. A superior business model that anyone could copy the next day is going to become a commodity return, 2 weeks later, right? Mm-hmm. So you don't want a superior business model that's easy. You want a superior business model that's hard. And so to really do this strategy right, you have to change the culture of your company. You have to figure out, we have, 25, 30 products. No one person can be an expert in all of those. So you got to figure out a way to bring the expert of a particular product to the customer. We call it partnering. You have to have the technology that tracks what the customer has with you today and what they don't have. Many banks don't even have that information that's at the sales counter.
Right.
And so it's about 100 things, and I'm not exaggerating when I say 100. There's no one silver bullet. There's 100 things that you have to do to change your company if you really want to do cross-selling and be customer-focused. Many companies, when they start down this road, say, this is going to cost me hundreds of millions in new technology. It's going to take years. I'm going to have to change my culture. It is not, and all that cost is up front before you see the benefit. I am not going to go through that process. I do pretty well, selling stocks and bonds. It's got me where I did today. And what they don't realize, however, is that because of these economic advantages, you can give a better deal to customers, and because they'll be loyal, over time, this cross-seller is going to take business away from them. And they're going to wind up one of these days, and it's kind of happened. There's really no independent investment banks anymore, right? They either have gone bankrupt or they've been bought by commercial banks, where you're starting to see this bundling.
Who owns the customer?
But some of these commercial banks have bought a lot of different companies, but they never have integrated it. So they're basically a conglomerate, and they say go cross-sell again, but none of their systems support it. They haven't changed the culture of the people, because it is all still a people business, and they haven't incented people to do the cross-selling. You have to inspect what you expect, and they don't get that. And so that's why, just like Walmart, everyone knows their strategy, but no one can compete because they're so far ahead of them in implementing their strategy. I think that's why it's been very difficult for our competitors to implement ours, because we started a long time ago, and we built our systems and our culture appropriately, and it's very hard for them to make the investments.
Right. The other thing that you're famous for is for the mergers and acquisitions that you've done in your life. At the time of you retiring from Wells Fargo, it became a $1.3 trillion institution. At a time when Norwest bought Wells Fargo, you were 20 billion, about there.
When I started Norwest, at the time we bought Wells Fargo, we were 100 billion. 100
billion.
But
right.
when we started we were
at
20
billion.
20 billion. Yeah.
So this kind of scaling, what is sustainably achievable in scaling, especially with the hindsight that you also need to be customer centric, you need to have consistent proposition, and all that you've said about incentivizing your staff and so on. What's achievable in terms of scalability, and can a Wells Fargo continue to grow?
One of the misconceptions is that large is bad and large is risky. Yet more small banks fail than big banks. So why? I would argue that at $1.3 trillion today, with 100 different businesses, 20 to 25 individual products throughout all of the United States, that Wells Fargo today is less at risk of failing than the old Norwest, which was basically a commercial bank, very narrowly focused in the Midwest, very dependent upon, directly and indirectly, on agriculture, which almost failed in the 1980s, which is how I got to Norwest. It was a troubled institution that I was asked to come in and try to help correct the problems and so on.
Right.
So what we have done is at the old Norwest, and it's still, we have a little more market share today, but let's say that the old Norwest, in the 5 states that we were doing business, we had roughly a 10% market share of banking. Today, in those same 5 states, our market share may be 15% of banking, 15 to 20% of banking. But we're still bigger than that because we're in financial services. But we only have about a 5% market share of the financial services market.
In terms of total assets?
Well, however you want to define it. Revenue, assets, we won't get into, that's pretty complex, but just however you want to define it.
Right.
The financial services business is about 5 times bigger than the traditional banking business. So if you get bigger, if we went from $20 billion in assets in Norwest in those 5 states to $1.3 trillion in assets in those 5 states, we would be much riskier and at risk of failing. But if the reason you have grown is you went into new states where you had 0 market share
and
built it to this 10 or 15%, why is big bad? And the reason small banks fail is because they're usually not only in one state, they may only be in 3 cities. And if a plant closes down or whatever,
out, yeah.
That's why they fail. So
diversification.
So I would argue geographic diversity. Remember the Texas banks back in the 80s? They were some of the most profitable banks in all of America. They had the highest PE ratios and so on. They all failed because the state failed.
And the oil industry.
S&Ls.
Yeah.
Remember the S&L crisis? They failed because they were concentrated in 2 products, commercial real estate and residential real estate. They weren't big, and yet everyone says big is bad. Concentration is bad, and the bigger you are in concentration, that's even worse. But if you're big because of diversification, it reduces the risk. That was my point of why we got into financial services. If we wanted to grow and with the same product line, we were going to get more risk. And I said, I don't want more risk. I want less risk. So I've got to diversify. But that then allows you to grow without taking more risk. And that's what we have today, is we basically now have the 10 or 15% that we still have in those original 5 states in 37 states.
Right.
And we've gone from just 2 or 3 products being offered to offering 20 or 25 products. And that diversification actually reduces risk.
Is this Wells Fargo franchise that you've described, is it uniquely North American? Is it uniquely American in that we would not find a Wells Fargo becoming international in its core consumer franchise outside of the U.S.? You mentioned Walmart, and Walmart has been sort of a touch-and-go case outside of the U.S. A lot of learning experiences in China, and it's not been that straightforward in Europe as well. So, is the American consumer banking franchise of Wells Fargo, being mindful of the fact that you are a great trade finance bank outside of the U.S.,
right.
You've got great people who do the legwork and go and meet people and so on.
We're number 1 in the world in that, as a matter of fact. From the old Wachovia acquisition, actually. It wasn't Wells Fargo that did this, but when we acquired Wachovia, we acquired the Financial Institutions Group.
So you're adding complexity to your institution. So it's not, the core proposition is not as straightforward as the Wells Fargo of San Francisco. The diversification has brought other forms of businesses which are becoming equally large, or I mean not equally, but significant with the balance sheet.
Well, you have 2 choices. Do you want to do something that you've been doing all along and know how to do it and become concentrated? And therefore, I say you're going to have more risk because external factors. You can still run that very well, but external factors can do it. Or you can trade off risk, let's call it credit risk or whatever, for operational complexity. Operational complexity you totally control. A macro event is not going to cause your operational complexity to blow up, right? But an economic crisis, which you have no control over, could cause all kinds of your businesses to go bad. So I would rather trade off things I can control to reduce overall risk than things I can't control. So the quick answer is Wells Fargo will not, I'm not in charge anymore, but I think it's very unlikely, will grow retail-wise internationally. As you said, we already serve financial institutions, and we're also going to start some commercial offices, commercial banking offices overseas to serve our U.S. customers. But we're not going to do local business, to any great extent. And the reason is we still have tremendous growth opportunities in the U.S. But, I used to run Citibank's consumer business internationally back in the 80s. The truth of the matter is there's many more similarities between commercial and retail banking internationally than there are differences. So the skills can still transfer.
Between countries, between regions?
Between countries and between regions. When I was running the New York banking division for Citibank, before I ran the international, I used to say after international that there was greater differences between the retail banking business in the Bronx versus Manhattan than there was between New York City and Hong Kong. That there's really, people want to save and borrow and have a mortgage and have a credit card all around the world. The difference is the culture of the organization, and it's just much easier for us to first expand domestically and get our market share than to try to establish a relationship or acquire a company in a international situation. So I don't think that will be on our agenda for some time, and maybe for never.
Is there more regulation today than there was before? I mean, given all the publicity that you see on regulation in the newspapers every day, you get that sense that there is more regulation today.
Well, I would say it this way. When I came into the banking business, it was very heavily regulated. You couldn't even bank across state lines. There was something called Regulation Q. You could not offer a savings account at more than 5%. Your lending, the prime was determined by regulation. So it was a highly regulated, from a product and from a geography, highly regulated in the prior to the 1980s. Then it deregulated because, again, you had this concentration problem if you didn't. So they deregulated products, pricing, geography, and then and we were in that mode until this crisis. So it was less. There was still a lot of regulation, but a lot of when it comes to products and geography, it was very deregulated. But with the advent of Dodd-Frank, I would say the regulatory burden today is multiple times greater than it's ever been since it was deregulated back.
It's 2,000 pages of.
Well, and the 2,000 pages, but there's going to be tens of thousands of pages of further regulation. The 2,000 pages just said to the regulator, go do this. Now the regulators come up and when they implement the regulation, there's another 1,000 pages. But the thing I want to emphasize is that the Dodd-Frank bill would not have prevented the last crisis and will not prevent the next crisis. The regulation is more of an anger and punishment of banks, even ones who did no wrong, for this crisis than it is, in my opinion, to ensure that that a crisis never occurs again. I'll say two things to support that. What does limiting debit card fees have to do with risk and the risk of bank failure? In fact, it hurts. It increases the probability of a bank failure because about 5 to 10% of our fees are now gone, and debit cards were of no risk. In fact, for a small bank I think the real travesty of this is I don't know how a small bank can survive with Dodd-Frank. Dodd-Frank was proposed to be, we're going to be able to eliminate big banks from growing. Look, at the one thing you know for sure about increased regulation is that it increases concentration. Because who wants to enter a business which is highly regulated? The marginal players leave you. Look at all the highly regulated industries, pharmaceuticals, telephones, cable television, network television, railroads, airplanes, nuclear reactors, cigarettes. They're all concentrated, more concentrated than industries that are not regulated. So they're doing the opposite of what they should be doing. And it's and what happened in this crisis, in my opinion, was about 20 financial institutions, most were not commercial banks, were the problem, not the 8,000 banks, and it was a failure of regulators, not regulations. So let me ask you a rhetorical question. Would you agree that Citicorp had some of the problems in this financial crisis, that caused some of the issues?
Yeah.
So what regulatory authority did the Federal Reserve not have to rein in the risk of Citicorp prior to this crisis?
Was not applied, you mean?
I can't think of any. And yet, they're saying that they didn't have the authority.
They weren't looking. Final question. The future of America itself. We're doing this interview, this conversation in Singapore. What do you see about Asia from where you sit in San Francisco that makes you reflect about the future of America, and how do you think that future should play out?
Well, I have never been more concerned about the future of America than I am now. When I grew up, we were a country that for every generation since our founding in 1776, the new generation had a higher standard of living, expected to have a higher standard of living than the previous generation. It happened for every generation. One of the most important reasons why that occurred was good education. So, myself and my siblings were the first people to go to college in my family. But if you had a good education, the sky was the limit, and you could be anything you wanted to be. And we were a free enterprise system. You could make a lot of money if you were good. You could, etc. You could start companies. It was just a vibrant economy with every generation, a new generation, expecting to do better than the previous generation. That is not the case in America today. My children, that generation, will be the first one that will have a lower standard of living, and the question is, will their children have an even lower? Are we sinking? And yet, I come to Asia, and I've been coming here now for about 30 years, and I see just exactly that same kind of momentum that we used to have. Every generation is going to have a higher standard of living than the previous one. The educational levels are much higher than they are in the United States of America, and that's why it's going to continue to be that way. There are entrepreneurs here. Every country you go to, you see new businesses being created, and they're competing on the worldwide stage, just like America was doing.
So what does America need to do to stop that slide? I mean, it's probably just a doorstop that's required to stop the slide.
I think what seems to happen in America is we have to suffer so badly that we finally do the right thing. And I think that's probably what's happening right now. I think that people there's all kinds of changes that are going on politically, and we'll see which direction that we head. And I am confident that we will, America will come back, because we always have had to kind of go to the precipice before we start doing the right thing. But it is scary. I think we're heading down a path, quite frankly, towards the European model. And that has never worked.
Where the state is large and entrepreneurship
Exactly.
is small.
France today, 56% of their GDP is the state. And France has never had an unemployment rate lower than 7% for 30 years. That's what we want to be. And that's where our policies are heading, in my opinion. And I think it's a mistake. That's not to say we don't need to make changes, and there were some sins that were made that need to be corrected. But the fundamental of in my opinion, the fundamental way to create increased wealth for everybody is the free enterprise system. And I think if you look at the countries that are doing well today versus the ones that aren't, those countries are freer today than they were in the past. The businesses are freer, it's closer to free enterprise, and they have a highly improved and educated workforce coming, much better than the previous generation. That's what worked for America, that's what's working for Asia today, and we've got to get back to that.
Dick, we could have a longer conversation on that, and your views on all of that front is very inspiring, and the story that you've built already is a benchmark for the rest of us. So I hope that we'll be able to talk again at some time in the future.
I'm going to enjoy that, Emmanuel.
Thank you very much.
Thank you.